mode.
Well, hi everybody, welcome to our first tutor2u macro webinar. I'm Geoff Riley and I'm speaking to you from the school library. There's nobody else here apart from me and quite a few of you on the web. This is a seminar on the UK economy. What I thought I'd do is take you through some of the main themes, some of the main issues, basically prime you with some good stuff just ahead of the exam. Please do ask any questions. You should find an opportunity to ask a question, and I'll try and answer them as many as possible towards the end of the webinar. I thought we'd start with a poll, just so I know which exam board you are taking. So can you please have a look at this quick poll and just choose which exam board you're taking. Thank you. Okay, 93% of you have voted already, and so I'm going to close the poll in a couple of seconds. And we find that 81% of you are doing AQA and 1/5 are doing Edexcel. So I'll try and focus my comments, skew them a little bit more towards AQA, but keeping the good people of Edexcel in hand. Nobody here tonight is doing OCR, pre-U or other, so we can ignore them for the purpose of this webinar. Okay, thank you for that. We're going to look at the state of play for the UK economy as we speak, and hopefully you can see the first slide, which is from the FT a couple of days ago. I think it's really quite interesting what's happening in terms of the IMF's debate with George Osborne about the direction of fiscal policy. The IMF has a relatively new chief economist, Oliver Blanchard, and a relatively new head, Christine Lagarde. And just a year ago, there was quite an intense debate between the IMF and the Treasury about the direction of fiscal policy. The IMF was effectively saying that the government should bring forward infrastructure spending as a way of stimulating growth. And, you know, as you head into your paper on Tuesday, it seems as if the mood music has changed a little bit, and the IMF is now becoming a little bit more in tune with the Treasury view, which is that the fiscal policy strategy set out by Osborne is starting to bear fruit and starting to have results. We'll come back to that a bit later on in the webinar. I think it's really quite important just to start off and think of the key objectives of policy. This is where you can bring, particularly the AQA students out there, you can bring your AS macro into play. And let's start off by looking at some of the key indicators of macroeconomic performance. I'd like to make a distinction between really three types of objectives. Let's look at some of them. The first is the kind of core domestic objectives. They're trying to drive growth in the economy, moving towards price stability, keeping employment rising, unemployment falling, and basically trying to lift living standards. And of course, with each of those topics, there is a huge policy debate. So if you take growth, for example, how can the UK achieve sustainable growth? How can it achieve balanced growth? How can it achieve fair growth, equitable growth? The inflation debate remains current. We'll look at that in a few minutes. The labour market is really interesting at the moment, what's happening there. And of course, there's a wider issue, huge issues to do with equity, fairness, inclusivity, inequality, the whole concept of well-being, how one measures it. These are really important objectives. The second group of objectives I like to revise is external. And here we focus mainly on the balance of payments. Keep in mind at A2 that you have to be aware of the capital account as well as the current account. But also, I think, generally this whole question of competitiveness. And I'm going to say quite a bit about competitiveness in the next half an hour. The Edexcel board in particular is really strong on this. You know, how can countries become more competitive? These two go together. If you're more competitive, your trade balance ordinarily should improve, both for the UK and for other countries. So make a distinction between domestic and external objectives. That's quite important. And the wider context is the nature of recovery. So keep in mind you're writing a paper in June of 2014. The paper was set probably 12, 15, 18 months ago, certainly a year before you're sitting the paper. And think about how the debate has changed between whether we're going to get recovery, can we avoid a triple dip, what type of recovery we're going to have, is it balanced, is it durable, how strong will it be? Those are big issues. Now within that, I think it's certainly vital for AQA students to be really familiar with the shocks, domestic and external, that can hit an economy. So please revise ahead of Tuesday demand and supply side shocks and the impact they have on the key variables. And then the whole wider discussion about rebalancing. How can the UK rebalance into the future? So this is my first slide, and it's really getting you to focus a little bit on objectives, going back a little bit to AS, but thinking a little bit more detailed, a bit more depth. Context is really important here. So let's have a quick look at where the UK is. First chart comes from the Office of Budget Responsibility, headed up by Robert Choate. And as you go into the exam on Tuesday, the inflation story is certainly looking more positive. Go back to 5 or 6 years ago, we had inflation twice of nearly 5%, certainly quite a volatile inflation. If you see this chart, for most of the last 6 years, inflation has been above target and considerably so. You could argue effectively the inflation target's been about 3%. But the story now, the news now is that inflation is much lower, below 2%, and this is the OBR's latest forecast in March 2014. Inflation in the UK is essentially at 2%, and obviously there's some volatility within it from month to month. Here's the Bank of England's forecast for inflation, the famous Rivers of Blood chart. I think we have Ollie Wood on the webinar tonight from Angle. Ollie and his team were the winners of the Bank of England inflation competition. I think they won about £3 million or something. Other than that, they're obviously clearly experts in monetary policy. And here's the Rivers of Blood speech chart for the Bank of England. Central forecast is nearly always that inflation will be at 2%, 2 years ahead. But notice there is some degree of uncertainty there. A lot of external shocks can affect inflation. I think the really interesting chart is the next one, and I just want to spend a couple of minutes on it with you. This is just CPI inflation for European countries. I think I've probably taken Germany out for some reason, but not to worry. And I think the really interesting story here for you as you go into the exam is the decline in inflation in the European Union as a whole, certainly in the last 18 months. As you start your paper on Tuesday, 7 EU countries are actually experiencing negative inflation. And helpfully this Google data, if you look on the right hand side, it kind of lists countries in order. So Austria has the highest inflation, Estonia, and then the UK. So we have the 3rd highest inflation in the EU at the moment. Also, although inflation in the UK is now below target, it is the 3rd highest in the European Union. But then if you work your way down, all the way down to the bottom part of the chart, bottom right, you can see the countries like Greece, Cyprus, Bulgaria, Portugal, Ireland, Spain. Now they are at or around deflation. And CPI inflation for the European Union as a whole is less than 1%. Now that is an issue to be aware of in the exam. The European Union, our major trading partner, is close to deflation. Think about the consequences of that for the EU countries themselves and also for the UK. As a kind of separate point here, I suppose, you should be familiar with the move by the ECB last week. They moved to negative interest rates, not the policy rate itself, that was shaved to 0.15%. The ECB is now charging an interest rate, a negative interest rate on deposits held by commercial banks with the ECB. So the ECB is pulling a few more levers to try and lift the single currency block out of deflationary risk. We'll see if it works. One of the reasons why inflation is falling in the UK is shown by the next chart. I think the one to follow here is really the green line. The green line shows sterling against the dollar, and you can see there's been quite a significant appreciation since the start of 2013. Many of you will find that when you go overseas on your holidays this summer. Again, think about the consequences of an appreciation of the exchange rate. Think about the effects using AD and AS. Many commodities are priced in dollars, so if the pound rises against the dollar, those commodities become cheaper. USA accounts for about 15% of trade. So all in all, it's quite a significant exchange rate. What you have there generally, though, is the fact that the currency is appreciating. Follow the green or the blue or the yellow line, it's appreciating there. And that itself is a dampener on growth, can certainly affect the balance of payments, and has an effect on things like inflation. The UK, of course, has a floating exchange rate. We don't intervene in the currency markets. Bank of England is a passive participant in that sense in the foreign exchange markets. We don't move to manage exchange rates. But also bear in mind that the bank kind of knows what the zero interest rates or close to mean for the exchange rate. So I think the bank is watching the currency quite carefully at the moment. What I want to move on to look at is the kind of the growth story for the UK and what's happening. This chart just shows the rate of growth of GDP for the UK since '96. You can see the recession in 2009, the slow recovery in 2011 and 12. We avoided a double dip. And that's the UK. If I just superimpose the world onto this chart, the reason for showing this is just to give you a feel for the fact that there is a world economy out there, and the UK is actually a fairly slow-growing country in the global context. In fact, the UK has grown less quickly than the world every year since 2003. And so the world economy, the global economy, is growing by about 4% per year. Now keep that figure in mind on Tuesday, because if you've got a question on China or India or Brazil or Mexico, the world is growing at 4%. So you can often put that figure relative to the growth rates you're looking at in other countries. So the UK is a fairly slow growing economy in that sense. And what I've done here is I've put the UK's growth rate set against the Euro area and against Germany. Now, there's a reason for doing this, and again this is context for the exam on Tuesday. You can see the depth of the recession. UK and Germany had a fairly similar recession in 2009, but Germany recovered much more strongly, much more quickly. Follow the yellow line there, Germany recovered quite strongly. The UK has struggled to achieve growth, but if you go from 2013 onwards and follow the dotted lines, you find that the IMF is forecasting that the UK will grow substantially more quickly than the Euro area as a whole, and Germany in particular. Of course, Germany is a subset of the Euro area anyway. Again, I think this is really quite important. Although the UK is growing relatively slowly in the global context, it's actually growing quite quickly in a European context. So 2.5–3% growth over the next 4 years each year is going to be probably quite significantly bigger than Germany. So the biggest economy in the European Union is set to grow by less than 2%, according to the IMF. Think about why that might be the case. This raises obviously interesting questions about where growth actually comes from. I mean, there's many theories of growth which are available, but growth essentially comes from higher productivity. It's not a mystery that countries which are more productive grow more quickly. Growth comes from getting more people into the labour market. I know some of you have been studying Abenomics, the Japanese structural economic reforms. One of the central pillars of Abenomics is to get more women into the labour market in Japan. growth comes from being innovative and being enterprising, having an entrepreneurial stock, and growth of companies which drive product and process innovations. And growth comes from investment. And if you think about questions about growth, those four dynamics really explain most of the growth in modern economies, advanced economies, and many others. So the question is, where's growth going to come from? This next chart suggests that the aim of the government to get manufacturing driving forward as a share of GDP really hasn't worked. Manufacturing output, if you follow the dark blue line here, manufacturing output is still less than it was in 2006. There's been a rebound in the last year or so, which is welcome, but it really has struggled. Construction is in green. Again, huge collapse in 2008, 2009, pick up in 2010-11, then another recession. So construction and manufacturing are struggling to recover. Services clearly doing very well, not all services, but the majority are, and they account for nearly 80% of GDP now. So what I take from this chart is that there are quite significant sector imbalances in the UK. Rebalancing has got a long way to go. Just in terms of competitiveness, I just wanted to share with you a couple of interesting features of recent data. This is taken from the World Economic Forum's competitiveness rankings. I just wanted to share a couple of things with you on this, and they're quite relevant here. They rank on the y-axis on the left-hand side. It's a kind of international ranking, and the UK and the USA come top for the quality of, this is peer reviewed, the quality of university industry collaboration. In your micro, you might call these external economies of scale, agglomeration economies, that kind of stuff. And the UK and the USA score very highly internationally on this. And I think that raises interesting questions, particularly about migration policy, about getting the best people to come in and live and work in our universities and our towns and cities, and encouraging those links between universities and industry, for example, through science parks. UK, USA is significantly ahead of the Asian tiger economies, ahead of South Korea, ahead of China, significantly ahead of the EU. Obviously, as you go down the right-hand side, you can see the other rankings there. This is important in terms of competitiveness. And a similar chart is this one, which is a ranking of the quality of scientific research. I haven't included Germany in this figure. Ollie, thanks for your question. I should have done, and I will do when I've published the final presentation. Again, the UK, USA, again, significantly ahead. You may be familiar with the whole issue surrounding the proposed bid by Pfizer, which kind of died a death a couple of weeks ago. But there are big issues here about the quality of our scientific research base, the closure of some labs in Kent. Britain can only afford to lose those kind of jobs. But by these measures, we actually rank quite highly in terms of competitiveness. One of the big weaknesses in the UK, of course, is that of investment. And again, this seminar is just to give you a few numbers, a feel for the scale of things. And this chart shows capital investment as a percentage of GDP. I've highlighted emerging, developing Asia. This is not just about China. If you take the whole of emerging and developing Asia, which includes China, so it's obviously a significant figure, they're investing over 42% of their national income, or forecast to next year. This data comes from the IMF, by the way. And that figure totally dwarfs investment in the oil-rich Middle East. North Africa obviously declined a little bit with the Arab Spring, but that's starting to pick up a little bit. Sub-Saharan Africa, 23%. USA struggling to get above 20%. Germany, 18%. The UK down at the bottom. So keep that figure in mind, please. The UK investment as a share of GDP is about 15%, which is just over a third of emerging and developing Asia. the figures really are quite staggering. One of the reasons is the savings ratio. I mean, Britain has, for many, many years, had a very low rate of saving. If you look at gross national saving, which is both household, industrial and government, then the UK appears pretty low down the list here, 15%, below that in fact in recent times, slightly higher in the USA, significantly higher in Germany, close to 25%. But when you get up to these countries emerging and developing Asia, they're 45% plus. Very, very high rates of saving. And the EdXL students will probably understand the links between savings and investment there and the theories you're asked to discuss. One of the counterparts to the whole debate about competitiveness is the balance of payments. I'm not going to spend too much on the balance of payments tonight, save for showing you this quite remarkable chart. And it's the sort of current account balance measured as a share of GDP. Norway, I think, is remarkable. And again, it's a country that is in the news. The EdXL students might be asked to think about Norway as a country outside of the single currency, outside of the EU, but inside the single market. Norway has run a current account surplus in excess of 10% of GDP for more or less the last 20 years. And there's a very, very strong current account surplus, although it's forecast to decline short in the next 3 or 4 years. Likewise, Germany has a persistent current account surplus of the order of 6–7% of GDP. So these are structurally surplus countries. Follow the next country down. If we follow the greenish line, pale green line, that's China. I suppose the big story there is that China's current account surplus has fallen from 10% of GDP in 2007 down to just about 2% of GDP in the last 3 or 4 years. So China's trade surplus, current account surplus, sorry, is significantly lower than it was a few years ago. A lot of students will go into the exam on Tuesday assuming that China runs enormous trade surpluses. And it doesn't. It has a large trade surplus in goods. Its current account surplus is significantly less. It's basically, well, you can argue 4 times smaller than it was a few years ago. And then as we look towards the bottom, then the UK, which is in red, is really struggling. The UK last year ran a current account deficit of nearly 4% of GDP, which suggests we've got some competitiveness issues there. The other story from this chart is Spain. If you can follow Spain, that's the kind of turquoise line. Go back to just before the crisis, Spanish economy running a current account deficit of 10% of GDP. That figure has moved hugely. I mean, Spain this year will run a current account surplus. So a country, one of the PIGS countries, country associated with the fiscal crisis, country associated with the European Eurozone crisis, is running a current account surplus, a contrast to the UK. It can be done. So where is the UK at the moment? UK is obviously recovering. Output in the UK is likely to have passed the peak by the end of 2016, if it hasn't already done so. Forecast to keep getting revised upwards. So GDP, sorry, real GDP in total, that's the darker of the 2 lines there, is probably already past the peak. GDP per capita will take much longer to recover. Population growth eats into that, of course. And the thing I would point out from this chart is that income per head is still lower now than it was in 2007. And it's likely to recover to the 2008 level by 2016. We're talking almost a decade of no growth of per capita incomes. Hence the need for the ONS to keep adding in things like drugs and prostitution into the last income data to boost the figures up by about 10%. Where does growth potential come from? Keep in mind, by the way, that this presentation is available as a PDF at the end of the session, so don't feel you have to write everything down. Just think about where growth comes from and thinking about the policy issues that are surrounding it. I mean, undoubtedly, the labour market is really key here. You increase the size of the active labour force. You need to improve the quality of workers. So migration policy is incredibly important. You will have views on it. I have views on migration policy. It's clearly political. What I would say, if you get an exam question on migration, please, please stay clear of the politics. Focus on the economics. Build your analysis, build your evaluation, but please avoid politicizing the debate. So the labour market's important. Likewise, financial reforms. And the coalition is doing quite a bit to try and encourage competition in retail banking. That kind of stuff didn't really come up in Unit 3, but you can make a holistic synoptic connection between competition in banking, Virgin Money, Metro Bank, growth of peer-to-peer lending, whether that will have an effect at a micro level sufficient to have a macroeconomic impact, in particular increasing lending to businesses. The other aspect I think is really important for the UK, particularly when it comes to the trade balance, particularly when it comes to sort of improving our overall wealth, is we need to move towards more high value production, manufacturing in particular, so 3D manufacturing, additive manufacturing, growing our service exports in things like health and education, building those kind of manufacturing clusters that have huge effects. Formula One, for example, in Northamptonshire, and technology companies in the sort of Thames Valley. Really important for growth in the UK. And then crucially, having smart, effective, well-ordered macro policies. So AQA students, you know, there'll be lots of questions on policy, lots of questions on how monetary and fiscal policy can work, the conditions under which they don't work. I think the big story probably this year is the infrastructure question. My instinct is that there will be some kind of question on fiscal policy and aggregate supply, and so have in mind some infrastructure projects that you could talk about, Crossrail, HS2, London Gateway, that kind of stuff. They're really quite important. The other thing to be aware of is, particularly on the macro policy side, is the fact the UK is exposed to a lot of external shocks. So the UK is a very open economy, and these shocks sometimes can be beneficial. There could be a stronger recovery in Europe, for example, which would help us, or they can be negative, maybe a big slowdown in China. But keep in mind that there are many shocks affecting the UK. These are some demand-side shocks here. There are some supply-side ones as well. China is clearly going to be a focus for many of you in your revision. Again, show the examiners you're aware what's happening in China. The IMF just a couple of days ago lowered their growth forecast for China to 7%. And there are some economists out there who think that actually China's growth rate is going to be significantly less than that in the next 5-10 years. Ricardo Hausmann thinks that China will grow by closer to 5%. There are plenty of economists out there who are predicting another credit crisis for the Chinese economy. The underlying dynamics suggest a growth of 5% is certainly achievable. These things will affect the UK. So if China grows more slowly, what are the effects on commodity prices? What are the effects on exchange rates? What are the possible effects on trade opportunities, trade and investment chances for UK firms? A few words on the labour market. And here the story actually really is quite good. Follow the blue line here, the rate of unemployment is now below, or is now, to the first quarter of 2014, is now below 7% and falling quite quickly. The rate of unemployment has fallen, the rate of employment has risen. So total employment in the UK is now at a record high. Again, putting that kind of stuff into context for you, oftentimes you're given some international figures for unemployment. You probably spot the UK there, which is in red. Some countries have very low unemployment. Japan, despite its troubles, 4%. Switzerland even less. And of course, up at the top, the unemployment crisis in Spain and in Greece. The Greek economy is recovering. Unemployment is falling, scheduled to fall, but from an incredibly high level. And there's a huge divergence there, and think about the consequences of that. One of the issues in the UK has been that the change in the nature of the labour force. And it's important to be aware, I think, of the rise of part-time employment and the rise of self-employment. You can see this pretty clearly from this chart here. Now, some of those part-time workers probably would want a full-time job. Some of the self-employed have given up the search for formal employment and gone back into self-employment. So this chart hints at a positive trend, people starting their own businesses or finding work. But it also hints at an issue of what's called underemployment. And many people out there who do have a job, they actually do have work, but they'd prefer to work more hours or have a full-time instead of a part-time job. So although the unemployment rate is falling, underemployment is a big issue for the UK. Keep that in mind, the distinction between unemployment and underemployment. And then, of course, the big story which many of you have already written about, researched, revised, I hope, is youth unemployment. And the figures here are pretty staggering. I mean, overall, workers aged between 18 and 24, nearly 17% are out of work. It equates to about 900,000 people. Staggering numbers, absolutely staggering numbers. Explaining why they're unemployed is complex. You can focus on the labour market in terms of the supply side. The youth unemployed workers have the right skills. Our training scheme sufficiently robust, outcomes in education. And you can also focus on the demand side. Fewer people retiring or people retiring coming back because the pensions aren't worth enough. Employers reluctant to take on younger workers. There's all kinds of analysis of why youth unemployment is so high. The best students on Tuesday, if this question comes up, they get to the heart of causation and they evaluate the policies linked to the causes. Good luck if you get a question on that. The other issue I think in the UK linking inflation and unemployment is real wages. I'm sure you'll be familiar with this. Ed Miliband has been going on about the squeezed middle. There's no doubt about it, real wages in the UK have fallen in absolute terms and relative to trend. So had real wages continued to rise at the pre-crisis trend level, they'd be a lot higher than they are now. Where next for interest rates? Well, who knows? Charlie Bean has just left the Bank of England and he thinks that base rates will reach 3% within the next few years. Who knows? We don't know where interest rates are going to go. They're likely to stay at less than 1%, certainly for the next year or so. I think the really interesting interest rate is probably not the base rate. I mean, the base rate is ultra low. It probably won't change much in the next year or so. I think the really interesting rate for A2 economists is the bond yield. And this is the next chart. Focus here in particular on the green and the blue lines for Spain and Italy. I mean, one of the remarkable features is that bond yields in those two countries have fallen sharply, from 7% down to close to 3%. In fact, you could argue that within the space of the next year, for example, bond yields in Spain and Italy could be lower than in the UK. So that's a really quite important movement in the market. And partly that's the fear of deflation in the Eurozone, and it's partly the strength of the recovery in the UK driving bond yields up. Fiscal policy is clearly huge. It's difficult to know what kind of question is going to come up on fiscal. There's so much happening. What I would do for revision is I'd make sure I've read the budget, 2014 budget and the key announcements. Coalition's doing quite a lot in terms of using fiscal policy to drive employment. They have cut national insurance, for example, for employers who take on long-term unemployed. They have increased the income tax allowance to above £10,000, significant renewable incentives, plus the big subsidy given to E.ON to build a new Hinkley Point nuclear power station. The expansion of the youth training guarantees through the youth contract, bringing forward investment projects, decisions about HS2 obviously pending, attempts to incentivize house building, And of course the big story is they've basically essentially delayed deficit reduction by about 2 years. And that in itself represents a kind of fiscal expansion. But there's a lot happening in fiscal policy, so please be aware of it. The big story I suppose is the fall in government spending. So the red line here shows total spending, the blue line shows total tax revenues. And obviously when the gap is at its biggest in 2009, 2010, that's when you get a budget deficit of 11%, the obvious point. 80% of deficit reduction, 80% or the bulk of deficit reduction has come from cuts in government spending. So the government is really trying to bring down the level of government spending in total, somewhere close to, if they can, 40% or less. When Cameron has this mind that 40% is some mythical optimal figure. Tax revenues rising, probably rising from about 36 to about 38% of GDP. Part of that is the rise in house prices and stamp duty revenues and that kind of stuff. But essentially the Office of Budget Responsibility, and here's the key point for tonight on this slide, the Office of Budget Responsibility are forecasting that the budget will return to balance in 2018. Now that is 10 years after the start of the recession, and it's nearly certainly 2-3 years after the government initially forecast. Okay, so keep that in mind. The government has delayed deficit reduction. The scale has been reduced. That in itself represents like a tweaking of the sort of fiscal policy of the coalition. And where's that squeeze come from? This chart is really quite interesting. It's taken from the Bank of England's inflation report, which came out a couple of weeks ago. Most of the fiscal squeeze has come from cuts in government consumption. Okay, so deep cuts in the civil service and cuts in, not frontline services, but cuts in the administration of government. Relatively little has come from benefits, although that's going to increase with introducing the welfare cap this year in 2015. The government shaved investment. They've kind of cut back on that a little bit. They're paying less in debt interest, which is important. In total, between 2010 and 2019, the fiscal tightening is worth 10% of GDP. That represents a significant tightening of policy. And so the order of the fiscal squeeze is pretty high. The question is, will it lead to growth? Is it the right policy to drive the economy forward? Thinking about debt levels, clearly deficits imply rising debt. Again, I just want to put this in context. Where is the UK relative to other countries? Our debt levels are, this is net debt, just a shade over 80% of GDP, forecast to rise to about 85%. You can see on this chart, Germany down at the bottom has significantly lower debts. Spain has lower debts. So too has Iceland, probably inflating most of those away. The big story at the top obviously is Greece and the Japanese level of debt. This is net debt. Gross government debt for Japan is over 200%. So Greece and Portugal and Italy and Ireland, they clearly have much higher levels of debt. That was basically a look at the UK macroeconomy. I just want to finish off the webinar by looking at just 1 or 2 points of evaluation of how to improve your exam papers. Here's the next slide. If you get questions on causation, I think it's quite important to recognize that most problems, most issues have multiple causes. So trade deficits, fiscal deficits, low productivity, unemployment, lack of competitiveness, poverty traps, constraints on development and growth. All of these big issues have multiple causes. And once you understand that, that immediately opens the door to talking about the range of policy options needed to address those causes. That links to the second point, that no macro policy works in isolation. Fiscal and monetary policy are separate policies, but they don't work in isolation. For example, the Bank of England buying government bonds through QE. Really good answers at A2 recognise the need for the right policy architecture, the right policy combinations, either on the demand or the supply side. And also keep in mind that it's a social science. We don't know how people respond. We don't know how banks respond to the incentives of lower interest rates. We don't know how exporters respond to the rising exchange rate. Economics is a social science, and policy is not precise, never has been. I think point 5 is incredibly important. And this is where Keynesian economics comes into being. For example, if you get a question on the size of the fiscal multiplier, I mean, the size of that effect depends fundamentally on psychology. I mean, it doesn't depend necessarily on the minutiae of propensity to spend and save and investment. Fundamentally, the impact of policy depends on confidence, sentiment, expectations. So fiscal policy reforms there of the coalition are designed to change expectations of how much the government's going to spend and borrow. Mark Carney's forward guidance is designed to influence expectations and confidence. Point 6 is made by every student. There are always time lags in policy and effect. Don't just mention the time lag, deepen the point, deepen the explanation. Why might there be time lags? And why does it matter? 7 is to use data. You're not expected to go into the exam and have an encyclopedic knowledge of every economy. Use the data in the question. Please, please do that. It's a data response question, not a data ignore paper. To get the chance, question the reliability of data, particularly if it's 2 or 3 years old. Hopefully that improves your evaluation. Just generally, I think it's important to know what's actually happening in the UK economy. Hopefully tonight's helped you. Can't stress enough the need to use the extracts. Many students drop a grade because they don't take all the application marks available to them. So please draw from the extracts in your answers. Pick off the low-hanging fruit. You'll get the credit. Point at the bottom here about ADAS analysis. I mean, again, it's kind of AS stuff, but many students don't make good enough use of the ADS diagrams they learned last year. Please, please do that. It's really important. And the importance of the final conclusion at the end of the essay is crucial for the 25 marker for AQA and for the 30 marker for EdExcel. Here's a few examples of ADAS. As I say, you can get a PDF of this webinar at the end. There are some examples of how you can use ADAS, particularly things like migration issues, multiplier effects, that kind of stuff, causes of inflation, impact of fiscal policy. Make sure you're using ADAS in your answers, please. I'd be very disappointed if you didn't. Just generally, this is the final slide before we just kind of wrap up and things, but you know, we're asked about evaluation and how to improve it all the time. Evaluation is an art. You're not going to learn to evaluate really well in the next 48 hours. But here's just a few thoughts on really good answers. One is they use the data, so the data itself becomes part of the evaluation, particularly if you can compare and contrast 2 countries, or there's clearly something significant happening in the data. You can pick it up and say, this is significant because, or this policy is having an effect on this because. You start with your analysis. Build your analysis. Clear, accurate, precise, key terms defined. Start with analysis, and the evaluation goes on top. It's always good to provide some real-world context. The best of you will do that. Most of the examiners are house trained. You know, they will award students who show their wider context. Sometimes the question explicitly asks for that, so do it. Cover a range of different policies: monetary, fiscal, trade, supply side, Keynesian-style policies, free market-style policies. Be aware of the policy domain. And the phrase I like to use is policy architecture. Which combination of policies or changes in policy, which do you think will have the biggest effect on the issue or the policy or the problem that you're trying to address? Think about short-term, long-term dynamics. Go back to what we were doing a few minutes ago about competitiveness. You know, what makes a country competitive in the long run? Be aware of the significance of changes. The pound has gone up by 10% this year. Is that significant? The price of oil has gone down by $5. Is that significant? China is going to grow at 7% this year instead of 8%. Is that significant? And be aware of the fact that policy has limits. Policymakers make mistakes. We live in a world of social science, and macro policy is rarely perfect. If it was, we wouldn't be in the mess we're in. And finally, end with a reasoned conclusion. Come to a view, try and say something fresh, link back to the question, don't repeat what you've already said, but try and end with a reasoned, calibrated answer to your question. So, just going to come out of the PowerPoint presentation. Hopefully you can still see me. Just a few things about the web support we're going to offer for the next couple of days. I know many of you will be using the blog. If you need to read through blog articles and stuff, there's a dedicated section for AQA Unit 4, Edexcel Unit 4. Just go to our blog and you can find it. It will all be there. Tonight's presentation is available as a PDF file on Dropbox, and I think Jim has tweeted the link. So please, if you want a PDF copy to print out, you're more than welcome to do that, and that should be available for you. We're just going to finish, I think, with a poll to see if people are still with us. And here's a poll question about the Coalition's fiscal policies. Are the Coalition's fiscal policies working? Please vote. Okay, well, 97% of you have voted already. We're going to close the poll in a few seconds. Okay, we'll close the poll and share the results with you. You seem to be a lot of fiscal conservative out there. 75% of people in tonight's webinar think that the Coalition's fiscal policies are working. Okay, and here's one more final question for you. It's to do with the Bank of England. When will the Bank of England start raising interest rates? Thank you for voting so quickly. You guys are really keen here. And we have a difference of opinion on this one. I'm just going to close the poll in a second. Okay, I'm closing the poll now. And there are the results. So 2/3 of you think interest rates will start rising sometime next year. 6% think there's going to be an early rise. A quarter of you think it's going to be 2016. You guys will probably be at university by then. But crucially, there are 3% of people, effectively 7 or 8 people in the webinar, who think they'll stay at 0.5% for eternity. And if they do, then I'll be very surprised, but I'll certainly be around for a few more years yet. If you are on Twitter and you want to continue the conversation, please, I'll be on Twitter after about 10 o'clock tonight and happily answer any questions. What I'm planning to do tomorrow sometime is just to run a live webinar on macro revision. I won't have a presentation to hand, but I'll be able to take any questions, and I'll be able to bring up onto the screen diagrams, charts, resources that you might want to use for your revision. But for the moment, I'd just like to thank you all for your participation in the webinar, and wish you all a very good evening. I'll be running a global economy webinar which kicks off at 9 o'clock. Until then, it's been great having you with us, and I'm going to log off now.